Hey guys! Welcome back to another episode of Stock Accurate, episode number 2 of Trading with the Bank series. As you know, guys, most of the traders always wanted to know exactly where the big banks and financial institutions enter into a trade in order to get big profits by joining them. In this episode, we will show you the key principles of the smart money trading system, which is known as the trading strategy of large financial institutions like the banks. Just remember that these important principles are all you need to know to trade with the banks and become a profitable trader. So guys, be sure you hit the subscribe button and click on the notification bell so you will know exactly when the new content will be released. So we will see you on the other side of the intro. Welcome back, guys. Let us get started. So what are the main principles of smart money trading system that every forex trader needs to know their definition and how to state them in the market? So these principles are order block, imbalance, break of structure, change of character, inefficiency, and liquidity. The first principle is order block. Order blocks are the optimized areas of supply and demand, and they form when central banks or large financial institutions accumulate large quantities of their orders in a small area, which can cause a drastic movement in the market. In other words, they form when there is an imbalance between sellers and buyers. If you still don't know how to identify order blocks and specify them in the chart, I definitely recommend you to watch our video clip about order blocks again to fully understand this important topic, as we will only discuss it briefly here. Here is the functional definition of order block, which helps us identify order blocks in the chart easily. Order blocks are formed before the drastic moves in the market. Exactly where the price rapidly pushes away from a specific area because of the lots of orders placed there. An order block is creating imbalance or inefficient efficiency that breaks the structure of the market or changes the character of the current market. The second principle of smart money trading system is imbalance. Let us see what its exact definition. Imbalance is an area of unequal market moves where there are only buyers or only sellers exist in the market. It is inefficient or unhealthy price action. It shows disequilibrium between buyers and sellers. An imbalance means unfair price action, which is showing itself by drastic and strong bearish or bullish candles in the market. Here we could see the examples of imbalances formed by the market. Let's take a look at the chart and see whether we can identify them in the chart or not. As you can see, there is a strong downward trend, and you can quickly see the drastic movements caused by the market imbalance between buyers and sellers. The third principle, which we are going to discuss, is break of structure BOS. When the price breaks a low or high, it is called a break of structure. It forms in the direction of the trend and creates continuation patterns so that you can join the trend. In a bearish scenario, BOS forms when the price breaks the previous low. As you can see here, in this downtrend, every time the price reaches a lower low, a new BOS is formed. And in a bullish scenario, it forms when the price breaks the last high. Let's take a look at the chart and see that we can specify the BOSs in the chart or not. As you can see, there is a strong uptrend. Here, the price breaks the previous high in an uptrend, so we mark it as a BOS. Again, the price breaks the previous high, so we highlight it. And the rest, just like the others. The next principle we will discuss here is the change of character. So let us look at its definition. In a bearish scenario, chalk occurs when the price breaks the previous high. In a bullish scenario, it occurs when the price breaks the previous low. Although the term chalk may seem to be arcane at first, but it simply refers to the fact that the market has changed through time. And all traders should keep this in mind when they are attempting to make the most of their trading opportunities. As you can see here, there is a downtrend that the price couldn't make a lower low, and finally, the price breaks its last low or high, and eventually makes a change of character. In the cases like this, after the formation of change of character, we are looking for the opportunity to enter into a trade by using the order blocks. In the next episodes, we will describe in detail how to place a trade by using the smart money trading system. Be sure you hit the subscribe button and click on the notification bell so you know exactly when the new content will be released. So guys, let's continue. As you can see, There's an uptrend which the price couldn't make a higher high and breaks its last higher low and forms a change of character. Let's take a look at the chart and see whether we can spot the chalks in the market or not. As you can see here, the price is in a strong downtrend, with momentum subsequently weakening to the point where the price could not maintain its trend. Finally, the price breaks through its last low and makes a change of character right here. As it continues, it forms these two order blocks, which gives us the opportunity to place buy orders in these zones and wait for the price to activate our orders. As you can see, the price activates one of our order blocks by reaching our optimized zone. Again, we have a strong uptrend here. As you can see, the price failed to reach a new higher high, so it started to lose its momentum and breaks through its last higher low, which eventually led to a change in trend, and showing us a change in character right here. As we go along, it forms these three order blocks, which allows us to place sell orders in these zones and wait for the price to activate our orders. As you can see, the price activates our first order right here, and our second order is activated right here. The fifth principle is inefficiency. Inefficiency indicates the lack of buyers or sellers in the market, leaving there's a long disequilibrium that eventually needs to be filled. If there is a gap with a large candle, that is the inefficiency of the price. Let's take a look at inefficiency in price action. As you can see from the left corner, there is a gap between the candles, and the price tends to come back and retest that area and fill the gap. We call this inefficiency. But at the right corner's candles, there is no gap between the candles, which is called efficiency. Let's take a look at the chart and see that we can spot the inefficiency and the efficiency in the market or not. As you can see here, there is a gap between the bullish candles, which we consider it as the inefficiency. Here in this bullish move, there is no gap between the candles, so we consider it as the efficiency. Again, we have the efficiency because the gaps between the candles are filled by the wicks. But here we have the inefficiency because of the gaps between the candles. And at the end there is no gap between the bullish candles. So we consider this move as the efficiency. And our last principle is the liquidity. Liquidity simply means money or large counter orders that must be fulfilled to spur the movement of market institutions. In other words, liquidity is used as the fuel of the market, which is vital and necessary for the market dynamics. And it always accumulates behind the dynamic trend line or above the equal highs or below equal lows in the market. And the reason why the market always tends to break through these areas is to gain its liquidity. That drives its movement. So that's it, traders. Thanks for watching. Please support us by like and subscribe. And don't forget to comment your opinions and questions. So see you in the next episode.